And now, an Envision Financial podcast with Luke Smith on Canberra's 2CC.
Once again, we welcome Luke Smith from Envision Financial. G'day, mate. How are you? Are you well?
Self? Yeah, no, really well.
You haven't got a cold?
No, I'm good.
Everybody else around here, they're all dying.
I was just going to say, I look out through the window in the studio and it looks like, hang on, it must be beers at the pub or something. There's no one here.
Well, I tell you, I said to somebody earlier this afternoon, I come in and do the shift on Sunday morning when it's basically me here.
Yep.
It's busier on Sunday mornings than it is out there.
I thought the same walking in earlier. It's amazing.
Yeah. Okay, let's get down to business.
Yep.
And the question today, should my investment loan be principal and interest?
Yeah.
And apparently everyone comes in with an investment loan that's P&I.
Yes.
And complains that it's costing them a lot of money to hold. And today we're going to talk about another option that could save you some cash flow pressure.
Yep.
The question being, what is the difference, for a start,
Yeah, look.
between P&I and IO?
Great intro there. And I think this is prevalent. Now, I preface this by saying, do what is right for you, but don't assume that something is better or worse. And what I mean by that is this. Mm-hmm. Everyone comes in and goes, I've got an investment property, rates have gone up, there's rates, there's land tax, there's costs, and I'm throwing 500, 600, 700, 800 a month at it and it's killing my cash flow. And I ask them, well, why have you got a principal and interest loan on an investment property? And they go, because the rate was lower or my broker said so. Now, again, it's not about right or wrong. I just want people to think about what is right for them. And what I mean is, if you have a principal and interest loan, the monthly payment is going to be more than if it's interest only, because we're paying the interest component only. We are not making a monthly payment of the principal. So, for example, if you had $1 million loan at 5.64%, the payment is $5,766. Now, if you had an interest-only loan at 5.84%, okay, so the rate's a little bit higher, the payment is $4,866. That's a $900 difference per month. And the reason I point that out is, don't assume that a lower rate is better. Because if you're trying to manage your cash flow, interest only, as I've just given you an example there, $4,866 is less than $5,766. Again, $900 difference.
I guess it comes down to your own personal ability to repay a loan, for a start.
Well, that's exactly right. But
capability.
If you're going to hold something for investment purposes, if you reduce the principal, you are reducing the debt and you own more of it. And a lot of people say to me, well, I did it principal and interest because I want to pay it off. Well, guess what? Interest only with an offset account will 100% achieve the same thing. And here's what I mean. If you had $1 million loan and you put $200,000 into the offset account, your monthly payment will fall to $3,893. Now, that is a lot less than the $4,800 example and the $5,700 example for principal and interest. So let's knock this fallacy on the head once and for all. If it's interest only, I can't pay it down. Yes, you can. Put an offset account on the loan and fill up the offset account. Any money in the offset account is effectively a loan repayment, because if you owe $1 million and you put $100,000 in there, in the eyes of the bank, you owe $900, and they only charge you on the $900. If you have a principal and interest loan and you put a couple of $100,000 in the offset, yes, you will save on interest, but your monthly payment will not drop. So again, we need to come back and say, what is my primary objective? I want to reduce the holding costs or the cash flow shortfall on my property, interest only with an offset account. If you inherited some money, you won lotto, you found a drum of money in your backyard and you wanted to put that on the loan and pay the property down, wonderful, you can. And the benefit of that is as well, with interest only, your monthly payment will fall. So the more you save, the less you pay. So many people come in and go, well, I have to have principal and interest to pay it off. No, let's bash that on the head right now, because you need the right structure for your cash flow. Because here's an extension of that example. If we can reduce your monthly outgoings on a property by $900, by having interest only, and let's say you save that difference into the offset account, you're not giving it to the bank. If the bank takes a principal payment, they take the money, it's gone. If it sits in the offset account, you still have 100% access to that money. Now, the wonderful thing is, what if you got to the end of the year and said, oh, I've saved an extra X, I can pull that out of my offset account because it's available to me in the offset account, in the interest-only example, and I can put that money into super, claim a tax deduction, and lower my taxable income. I would rather people have access to that $900 per month over the course of 12 months to then be able to use it for other strategic benefits.
So based on that, Luke, I mean, why would you want to go for a principal and interest loan?
Well, you wouldn't. And a general, I think...
But people would come to you and say, look, I want this principal and interest loan.
Yeah, but again, that's only because since the dawn of time, people hear the word interest only and go, start shaking and sweating and go, oh, but I want to pay it off.
How do they go?
They go,
That's very good. That's very good.
That should be the start of a new song, I reckon. But I just want to bash that fallacy on the head, because it's not something that is legit. And I can understand, the older generation having that view and passing on that view to their children, because back in the day, an offset account didn't exist. So a true interest-only loan back in the day was you only paid the interest costs, so you didn't make any inroads in the debt. But however, with the introduction of offset accounts, wonderfully powerful structure, wonderfully powerful vehicle. And again, I think a good broker here is worth their weight in gold, because they explain to people the difference. A lot of people just see a lower rate and go, 5.6 is better than 5.8. And then they realise that their payment is a lot higher and go, hang on, how is this good for me? And again, we need to come back and say, what is our purpose with that property? Well, I want to get a tax deduction, but I want to limit the amount of money that the bank takes. Great. Have an interest-only loan. If you're an absolute lunatic and you can't save and you can't manage your money and the only way you can pay that down is principal and interest, then maybe that loan is right for you. And if you are that sort of lunatic, that's fine. Just acknowledge that you are. And
I think you've just upset half of our audience.
and use a vehicle that is there. But I think a lot of people have one only because they don't understand the alternative. And when I explain it like that, they go, well, how do I get that fixed?
Yeah,
beautiful.
Please.
So
can you change can you change halfway through or part way through?
All you do is just go to your mortgage broker and say, hey, can we refinance this somewhere else?
Yeah.
And you'll be able to get a much better deal. And I think with rates getting cut, people should really now be shopping around and finding that rate. Look, if you don't have a mortgage broker, just bring my office. I can give you the name of 5 or 6 really good ones that will understand exactly what you're going to say, because they've probably done it for me and tons of my clients a million times over. So they have a similar view to me, which is why I sort of tried to use this with it. It's very topical at the moment because interest rates have just been cut, and hopefully that gets passed on. And
could happen again next month.
We could have a few more. So again, this is why it's very topical at the moment to be across the right structure, because it's about managing your cash flow, it's about managing your tax deductions, and not giving the bank any more than you need to, but also having that capacity to pay something off. Because if you've got rent that covers interest and it's neutrally geared, right, you can leave that property on the shelf for your kids for the next 25 years. You might have 15 years to retirement. You might then want to build up your super and maximise deductions and do other things with your cash flow. If we can free up your cash flow by getting your loan structure right, nobody likes paying crazy amounts of money into a property hoping that it goes up and seeing not much in the way of cash flow benefit by having the wrong structure. So work out what's right for you, get some advice around what your options are, compare the market, see what you've got in relation to principal and interest, and don't assume that a lower rate is better, because this is about managing your cash flow, not managing the interest rate.
Okay, we'll take a break with time at 40 minutes away from 5 o'clock. And you're with Luke Smith from Envision Financial, as we are each and every Friday afternoon at this time. And Luke Smith from Envision Financial is our guest, as always, on a Friday afternoon at this time. What are the key things that people can do to structure their investment loans correctly? And we're talking, of course, on the difference between investment loan and principal and interest loans. Well,
exactly.
What about structure?
Yeah, so interest only with an offset account will allow you to pay down the debt. Okay, so again, we said before the ad break, let's squash this assumption that you have to have principal and interest to be able to pay down the liability. You don't. You can have an interest only loan with an offset account. You can have $1 million loan. You can throw $1 million if it fell out of the sky into the offset account, and you've effectively paid off the property. So have the right structure for your cash flow. As I said before the ad break, if you're a lunatic and you can't save and you just can't be trusted, principal and interest is fine for you because you will slowly pay that down and it'll be a forced saving, and it's probably good for you if you have no discipline. If the rent covers the interest cost and it's neutrally geared, you can leave it alone and then use money to maximise super, pay off other debts, pay off your primary residence, and use that cash flow that would otherwise be given to the bank under a principal and interest environment. And before the ad break, we looked at the difference between two interest rates. Don't assume that a lower interest rate is better. You need to ask a better question and say, what am I trying to control? The cost or the cash flow? Because managing the cash flow can reduce the difference between a big gap in I've got $5,000 a month of interest and I've got $3,000 a month of rent. If you can get an interest only loan and bring that down to 3.5 to 4, it's almost neutrally geared, or it's going to limit the need for you to throw in additional money, which I find a lot of people really don't like, especially when the cost of living's gone up and you've got a change in situation.
But if you're renting somewhere, you've got an investment property and you're renting somewhere, if the rent covers interest, well, you can hold on to that property forever.
Exactly, and that's what I mean. If you can get it neutrally geared, you've got an estate asset for your children, you've got something that you can pay down later with superannuation or savings or whatever you decide to do in relation to what your why is for that property. A lot of people just hold stuff to see the value go up, which is great, and that's one of the main reasons that people buy investment properties, and then they look to try and sell them before they move into retirement phase, or sell them after they finish work to lower the capital gains and then throw the money into super. So if you can get rent to cover interest and hold that from a neutral cash flow perspective, wonderful, that's great. Let it cook and just let it do its thing, and you can then go about paying off your primary residence or whatever it may be. But make sure your loan is structured for you correctly. If you pay something down and then want to do something else in relation to drawing money out or buy another property, get an interest-only facility against that property as well. Have an offset account and use the money to limit the cash flow that the bank is going to take. Principal and interest will cost you more, interest only will cost you less, and over time you may find that you can use that difference or that cash flow saving for super contributions for you, super contributions for a spouse, kids' school fees, whatever it may be. But just don't assume that principal and interest, because the rate is lower, it's better. In the example we spoke about before the ad break, the interest only rate was higher, but the payment was less. So just ask. And again, it's more like a deer in the headlights. Ooh, cheaper rate, let's have one. But you actually need to think a little bit broader than that and think about the impact on your cash flow.
Yeah, I guess I would imagine the main thing that people do consider when they're looking at this is, yes, if I do interest only, they figure, well, I'm never going to own the place. I'm never going to own
Correct. And that's
property.
why you must tie an offset account to the loan and go to your broker and say, hey, I'd like it interest only with an offset account, please, because then you can throw anything you want into that offset account. You could even have a principal and interest loan, as we said before in that example, $5,700 against $4,700, and that $1,000, if you just want to leave that in the offset account, I'm fine with that because you're building up a nest egg of capital that you can get. If the bank's taking it, you may not have the same access to that money because it's paying down the principal. The bank now has your cash. If it sits in your offset account and you get to June and go, I've got $10,000 in that offset account, that'd be a great way to fund a deductible contribution to super that would then save me $2,500 to $3,500 depending on my tax rate. What a wonderful use of that saving to then further lower your tax rate. With principal and interest, the bank's got it.
Yeah.
So you've missed out on that ancillary opportunity from a strategic perspective. So again, it's not about is it better or worse? It's not about do I have to or not? Just think about it, because I find a lot of people come in office and go, that thing, it's killing me. I'm throwing this much at it a month. Oh my God. Well, did you know you can do that? That'd be a lot easier for me to hold it long term if I could reduce the cash flow impact of it. Go to your bank, or better still, get a broker involved. They'll be able to find you the cheapest rate, because when was the last time the bank you're with called you and said there's a deal somewhere else.
It doesn't
Right?
happen.
Exactly. So, people there go, but I'm with this bank and, well, they don't care.
Yeah.
Right? Unless you've got 3 or 4 commas in your loan, which you won't, they don't care what you've got.
Yeah.
They're not ringing you up. ANZ's not ringing up going, Westpac have got an amazing deal. That's never happened to me. Has it ever happened to you?
No.
So get a broker involved because they'll know what's sharp. They'll know where you can go. And especially for the self-employed people out there, they'll know a bank that understands your industry. Because a lot of the time as a self-employed person, and it comes to the lending lens that a bank has, you're a terrorist to start with unless you prove otherwise. But different banks have different understandings of different industries. And that's where a broker can add real value to your situation by knowing where your deal can go at a different lender. So you don't waste a ton of time and you get the best outcome and flexibility that you can take advantage of.
Okay, let's just let people know where they can get more information.
Yeah, so office number 62604749. We've got envisionfinancial.com.au on the internet. We've got the podcast, the Strategy Stacker. Luke Talks Money on iTunes and Spotify. And we've got YouTube, Envision Financial Canberra. We've got a backlog of all the shows. You can watch that on your phone. And all of this type of stuff is in Smart Money Strategy, your ultimate guide to financial planning, available just about everywhere.
That it?
That's it.
You left me with 29 seconds. Okay. I'll just repeat that number. That's 02 6204 749.
You're right.
I know. It's Friday afternoon. What the hell do you expect?
It's all good.
Good on you, Luke. Always good to catch up, mate. Enjoy your weekend, and you'll be back with Leon, presumably, next Friday afternoon.
Take care, mate. Good to see you.